Welcome to another episode of Real Estate Investing Explained. Here's today's question. Of course, it's going to vary from deal to deal, but what returns are you generally seeing in note investing, both on the side as the note owner and on the side of the private investor that's lending you the money for this strategy?
So there's a note investor, and it varies with the market, right? So note values are in direct correlation to real estate values. So if you're in an up real estate market, the cost of notes are up, and that means the yields are less, right? So right now, most yields on residential mortgages to the note holder, like a small guy, investor, would probably be in the 8 to 15% range. Usually it's right below hard money rates typically. For us as a note fund, obviously we're doing probably better than that. We pool capital. We raise capital from 4% to 11.6%, depending on liquidity. So we have multiple options. We have a 60-day liquidity, a 6-month, a 1 year, a 3 year, that kind of thing. Our investors can compound as well. So that's why there's a variation in rates. But we're typically on first mortgages that are non-performing that we invest in. Our yields are normally between 18 and 22%. On junior liens, they're very common to be north of 30%. We just can't get enough of them. Can't buy unlimited supply. When it comes to reperforming loans, RPLs, that are usually in our liquidity funds, our cost of capital is around 5, but we have a coupon rate north of 12. So we're making that arbitrage between 5 and 12. That's how we make money. Just like in our non-performing funds, our cost of capital is right around 9-ish, and our yields are 18 to 22. That's how we make money.
For those who aren't aware what non-performings, can you explain what that is?
It means they don't make their payments. Well, yeah, a non-performing, typically we're talking about first mortgages that are non-performing. Just means they haven't paid in more than 3 months, 4 months, and they start to go out non-performing.
And then do you generate the return by foreclosing on those properties?
It's a combination, modifications, or on occasion you're taking back properties. It depends whether they're occupied or not. There's a lot of variations there. And junior liens are a different animal as well. The senior lien status is actually more important than, say, equity into determining outcome. And with junior liens, very statistical. First mortgages is a little different. It's more about sticks and bricks and geography and location, things like that.
I was a bit surprised to hear that the returns for the smaller investors were as high as they were, given that mortgage rates are usually 4 to 5%. I was surprised to hear that they were north of 8 to 15%.
Yes. Usually first mortgages, unless it's like you're probably looking at it compared to a newly originated first mortgage with perfect credit, 800 credit score and all that kind of thing. Yes, they're a lot lower coupon, right? In the seller finance world, they tend to be higher than that. And the commercial notes tend to be higher than that. But a lot of our notes that we sell were once defaulted, now reperforming mortgages. So it's more of a scratch and dent category that pays a higher yield.
That's all for this episode of Real Estate Investing Explained. Be sure to follow me on Instagram, Twitter, and Facebook, or subscribe to our YouTube channel to get even more free content.